When you hear market prediction for tomorrow, what comes to mind? Is it those analysts shouting on TV, or maybe some bold forecast you read on a financial blog? But what if I told you that the real prediction, the one that truly matters, isn't about what some pundit thinks? It's about what the cycles, the indicators, and the hard data are already screaming at us. This isn't speculation. This is analysis. Based on decades of monetary policy, debt accumulation, yield curve behavior, and the very structure of our financial markets. What's coming isn't just another downturn or a mild recession.
There is a growing body of economic signals suggesting that tomorrow's market may be on the edge of a systemic crisis, one that could make 2008 look like a warm-up. And the scariest part? Most everyday investors won't even realize what's happening until it's far too late. In the next few minutes, I'm going to lay out exactly what these warning signs are, why they matter more now than ever, how they all tie together, and most importantly, what you can do today to prepare for the shockwaves that could reshape global finance. So let's dive into the hidden forces at play.
First, we have to talk about debt. Corporate, government, and consumer debt has skyrocketed in the past decade. We're talking about levels that are far beyond what can be easily managed without artificially low interest rates. To keep the system afloat, central banks around the world have printed trillions of dollars, pushing interest rates towards zero or even into negative territory. This has created an illusion of stability. Asset prices, whether it's stocks, real estate, or even collectibles, are inflated.
But they're not inflated because of real earnings or sustainable growth. They're inflated because money is cheap and abundant. Now think about this. When interest rates eventually have to rise, or when that fire hose of liquidity tightens up, what happens to this house of cards? It could collapse. And that's not a doomsday prediction. That's just the simple mathematics of leverage. Second, let's look at the yield curve. You might have heard of it. Historically, when long-term bond yields fall below short-term yields, an inversion, a recession almost always follows. It's one of the most reliable indicators we have, but today, the signals from the yield curve are far more complex and, frankly, more dangerous. We're seeing distortions not just from central bank manipulation, but from massive global capital flows. Emerging markets, giant pension funds, and sovereign wealth funds are all parking their money in US debt, warping the traditional signals. This means that when the curve behaves strangely, like uninverting rapidly, the risk could be much bigger than what the old models anticipate. Why? Because the pool of capital driving these moves is no longer just domestic. It's a truly global force, and when it shifts, it can shift with the power of a tsunami. Third, and this is crucial, is the market structure itself. The Wall Street of your parents' generation is gone. High-frequency trading, algorithmic funds, and complex derivatives have replaced the slower, more deliberate investment style of the past. Today, systemic risk is literally embedded in code. A sudden drop in the market can cascade faster than any human trader can possibly react. Automated programs will trigger sell orders. Liquidity, the ability to buy or sell an asset easily, can vanish in seconds. And those investors who think they can just ride it out might find out, far too late, that their strategy didn't account for real-time, automated liquidation cycles that don't care about buying the dip. It's a completely different ballgame.
Now, if you're watching this and you're feeling a sense of urgency, I want you to comment below right now. I want to be prepared for tomorrow. Go ahead, type it in. Because the next part of this video isn't just about fear, it's about empowerment. I'm going to teach you not just how to survive what's coming, but how you can potentially take advantage of the opportunities that every crisis creates. Think about it. By the time most people are panicking and selling everything at the bottom, the smart money, the informed money, will have already repositioned itself. They will be buying assets for pennies on the dollar from those who were forced to sell. This isn't just for Wall Street insiders. Whether you're an experienced investor, a diligent saver, or just someone trying to protect your family's future,
Understanding these signals is not optional anymore. It's absolutely essential. So stay with me. I promise this next part of the analysis will fundamentally change how you see the markets, and more importantly, your place within them. All right, let's get into the practical side. How do we prepare? The first step is to shift your mindset from offense to defense. For the last decade, the mantra has been, buy the dip. That works in a bull market fueled by cheap money. But in the environment we're heading into, a dip might just be the start of a cliff. Defense means reevaluating your risk exposure. Are you over-leveraged? Do you own speculative assets that have no real earnings or utility? Assets that are only valuable because someone else is willing to pay more for them tomorrow? Now is the time for a serious audit of your portfolio. This brings us to asset allocation. The traditional 60-40 portfolio of stocks and bonds may not be the safe haven it once was. If both stocks and bonds fall at the same time, which is entirely possible in a debt crisis, that strategy fails. So what are the alternatives? We need to think about assets that perform well during periods of financial repression and uncertainty. Historically, this has meant physical assets. Precious metals like gold and silver have been a store of value for thousands of years. They are nobody else's liability. Unlike a stock or a bond, they can't go to zero. They don't rely on a CEO's performance or a government's promise to pay you back. They are tangible wealth in your hand. While many financial advisors today will dismiss gold, remember that during every major currency crisis in history, it has served as a vital anchor for wealth. Beyond metals, consider other real assets. Productive farmland, for example, has intrinsic value. People will always need to eat. Real estate can also be a good store of value, but you have to be careful. We need to distinguish between a primary residence, which is a home, and investment properties bought with high leverage, which could become a liability in a downturn. Location and cash flow are king. Now let's talk about cash. In a deflationary shock, where asset prices are falling, cash is king because its buying power increases. But in an inflationary crisis, where the value of the currency itself is being destroyed, holding too much cash is a guaranteed way to lose purchasing power. So what's the answer? It's not just about holding dollars. It's about holding the right currencies, or having a portion of your cash and assets that are resilient to inflation. The key is flexibility. Having a dry powder fund, a stash of cash ready to deploy, allows you to buy incredible assets at bargain prices when everyone else is forced to sell. This also means looking outside of traditional markets. The world is changing. The dominance of the US dollar is being challenged. Having some exposure to international assets, particularly in countries with stronger fiscal positions, could be a smart diversification play. It's about not having all your eggs in one basket, especially when that basket is showing signs of cracking. Another critical step is to reduce your personal debt. In a rising interest rate environment, carrying high interest debt like credit card balances is financial suicide. The same leverage that amplifies gains on the way up will amplify losses on the way down. Getting your own financial house in order is the single most powerful move you can make. It gives you resilience and options that indebted people simply don't have. Finally, and this might be the most important point of all, you need to invest in your own knowledge. The financial system is designed to be complex and confusing. That's intentional. It allows insiders to profit from the ignorance of the masses. By watching this video, you've already taken a step to break out of that. Continue to educate yourself. Read books on economic history, follow independent analysts who aren't beholden to a big bank's narrative, and learn to read the signals for yourself. The coming crisis will create the largest transfer of wealth in modern history. The question is, will you be on the losing side of that transfer or the receiving side? The choices you make today, right now, will determine the answer. Don't wait for the mainstream news to tell you it's time to panic. By then, the game is already over. The time to prepare is now, while the waters are still relatively calm. I hope this has been eye-opening. This isn't about scaring you. It's about preparing you. True wealth isn't just about making money. It's about protecting what you have and having the wisdom to act when others are frozen by fear. We're going to be covering these topics in much more detail in the weeks to come, with specific strategies and deep dives into the assets we discussed. All right, let's ditch the hype you hear on TV and talk about what's really driving the markets. Tomorrow's stock prices aren't a reaction to tomorrow's news. They're a reaction to years of pressure building up inside the financial system. What we see tomorrow is just the first leak in the dam. Major institutions, the big money, they aren't staring at daily charts on their phones like most retail traders. They're studying the big picture: macro liquidity flows, bond rollover schedules, corporate earnings compression, and shifts in global supply chains. And right now, the single biggest clue about tomorrow and the months ahead is the weakening velocity of money. Think of money velocity as the heartbeat of the economy. It's how fast a dollar changes hands. When it slows down, it means fear is rising. People are holding on to their cash instead of spending or investing it. History shows us a clear pattern. Whenever money velocity drops while debt is high, the market is forced down one of two paths: either a controlled, orderly correction or a chaotic, disorderly liquidation event. And here's the kicker for tomorrow. So much of our modern financial system is automated. If algorithmic trading systems detect even a hint of fragility, a spike in volatility or a drop in liquidity, the move could be much sharper and faster than anyone expects. Retail investors always ask, will the market go up or down tomorrow? That's the wrong question. The real question, the one professionals are asking tonight, is, where is the money flowing?
Is capital rotating into safe haven sectors like utilities and healthcare? Is it fleeing from small cap growth stocks? What's happening in the bond market versus the stock market after the closing bell? Right now, several signals are flashing amber. Futures positioning shows that big institutions have been quietly increasing their hedges. This is their insurance policy.
Smart money is moving into high-quality bonds and gold while trimming their positions in overvalued tech and consumer stocks. Now, this doesn't guarantee a crash tomorrow, but historically these exact capital flows have consistently preceded significant market downturns. Combine that with other signs. Traders are paying more for options that protect against a fall. The put-call ratios in certain indexes are unusually high, and the amount of cash flowing into money market funds, the safest place to park money, has hit multi-year highs. Investors are prioritizing safety over growth. The signal is becoming crystal clear. Tomorrow might not be the day the system breaks, but it could very well be the day institutions officially step back from risk. And once that trend starts, the average investor will definitely feel it. So, what should you do? First, build liquidity now. Increase your cash position strategically. I'm not saying sell everything. I'm saying reduce your exposure to the most vulnerable assets and give yourself flexibility. Second, look at what happened before every major correction in history. The smart players made 3 moves. They strengthened their defensive positions, they focused on companies with strong cash flow, and they invested in real, fundamental value, not hype-based speculation. Third, you need to understand behavioral timing. When markets fall, it's not the first drop that does the real damage. It's the second wave, when mass fear kicks in and retail investors sell at the bottom, locking in their losses. The difference between losing 30% of your portfolio or potentially gaining 40% after the crash comes down to one thing: whether you act ahead of the crowd or with it. Fourth, start tracking the right indicators. Don't just glance at them, track them daily. I'm talking about bond market stress signals, dollar liquidity flows, the spread between corporate and government bond yields, and institutional hedge ratios. These are the dashboards the largest funds in the world use to decide if tomorrow is a day to take risk or a day to get defensive. And here's the honest truth. Even if the market ends up green tomorrow, the underlying system is still under immense pressure from tightening financial conditions. Unless central banks step in and start pumping liquidity back into the system, the market is getting closer and closer to a major inflection point. When this video ends, I want you to look at tomorrow differently. Don't see it as just another trading session. See it as part of a controlled countdown. Every single day that we move forward under the current monetary policy brings us one step deeper into the pressure zone. Whether tomorrow triggers a small shift or a major signal, it will contribute to a developing pattern, a pattern that has always ended the same way throughout financial history. Think about it. Before the crashes of 1929, 1987, 2000, and 2008, the biggest players exited the market slowly and quietly. And then, all at once, the bottom fell out. That moment of freefall isn't decided on the day of the crash. It's decided in the days and weeks of positioning that came before it. And that's why paying attention right now is so critical. If you want more deep, data-backed breakdowns like this one, hit that subscribe button, turn on notifications, and leave a comment below saying, "I want tomorrow's insight today." This channel isn't about hype, it's about preparation. In my next videos, I'll break down exactly how to track institutional liquidity like a professional. I'll show you the specific indicators hedge funds use to anticipate major turning points. And most importantly, I'll explain how you can position yourself not just to protect your finances, but to strategically accumulate assets during forced liquidation events, when everyone else is panicking. What's coming isn't random. It's not luck. It's the convergence of cycles, structure, psychology, logistics, and mathematics, all happening in real time. And while you can't control what happens in the market tomorrow, you can control your awareness, your preparation, and your strategy. The markets could start shifting as early as tonight in futures trading. When it happens, remember this moment. You heard it here first. You prepared before the signal became mainstream news. Because the greatest advantage in finance isn't capital, it's foresight. Thanks for watching.